So time for another portfolio update on my Hargreaves Lansdown investment portfolio. I cannot believe we're already more than halfway through the year, and what a crazy year. Unfortunately, pretty disappointing year it's been in the stock market so far. As you would have already seen, we're officially in a bear market, at least according to the S&P 500, which is down more than 20% year to date. And the only thing kind of holding us together is our beloved FTSE 100 here in the UK, which is only down around 5% so far year to date. Now, basing on last month's results, we were at a value of around £43,825. Now, a couple of big events have changed so far, so I've got some exciting news to share with you now. There was a big sale I've made in the account, and then I've opened 2 new positions, and we've also got some dividends to talk about. So let me get on the laptop and we'll get the portfolio up so we can have a look at all of the gory details. I mean, there is some good in there as well. So for the keen-eyed amongst you, you might remember that I did have a position in BP, and during the last portfolio update, I asked you and said, what should I do with it? It had a big gain. I think we were over about 120% up since the time I'd actually owned the stock, and I was concerned that oil stocks were looking a bit frothy, they were looking quite expensive, and I thought the general sentiment in the market from different governments around the world, including the UK, was that we're not happy with them making so much profits. They're of course relying heavily on commodity prices. There could potentially still be some upside in the price of it, but I thought personally, it doesn't really suit my investing style. I wanted to give it a go. And I was either going to sell part of it and just sell the gains, but I ended up just selling the entire thing. And the funny thing is, I'll put this up on screen now. I'll show you what I actually sold BP for, but it was literally at the top of the market. If you go on the Google price and you look at the price chart and you see what it closed the day at, on the day I closed it, I actually achieved a better price than that price itself. So I actually bought right at the bottom and I've sold right at the top. So my investing career is now complete, so I can completely give up. So anyway, I sold that one and I had my eye on a couple of different stocks which had been beaten down over the past 6 months, if not more than 6 months so far. So let's talk about my 2 different new holdings. First up was a holding which has been completely destroyed, and that's PayPal. I managed to get 26 shares of the company, and for a total cost of £1,812.42. Now, the reason I chose PayPal, I do think it's one of those areas that, of course, have beaten down unfairly. I think the valuations show at the moment there's a massive upside compared to the downside in this stock. I think the company's got a great moat in its sector, in that payments processing sector, and lots of different companies rely on PayPal to run their business and take care of the payment side for them. I definitely think that in 2021 and 2020, the stock got way ahead of itself. Lots of people made lots of money because PayPal was in lots of people's portfolios. And of course, they got very, very much excited, but I think it definitely got ahead of itself. There's still going to be some short-term pain in PayPal. There's definitely some expectations that the revenues aren't necessarily going to grow, at least over the next couple of years. But in the long term, and some of the valuations I've done, at least for the next decade or so, I think I should be in a good spot. And again, there's probably going to be more upside than there is downside in this stock. Now, where most of the money went, and probably the most exciting one, is getting 2 full shares of good old Alphabet, so the parent company of Google. Now, I managed to get 2 full shares, like I've just said, at £3,795.01 as my total cost basis. Now, by the time we get round to the next portfolio update, we'll actually see a stock split from Alphabet because they're doing a 20-to-1 stock split. So for my 2 full shares here, we should see me getting 40 shares, and that stock price be reduced dramatically. Of course, you're not getting any more of the company, but I think with that stock split, you're probably going to get more entrance into the market, because unfortunately, on platforms like Hargreaves Lansdown and lots of other legacy platforms, you can't actually buy fractional shares. So I decided to put most of my money into that one. Again, I think Alphabet is now down at some much more favorable valuations. I don't think it's at this point overvalued. And in fact, I'm only just slightly up in this account. We've had a little bit of recovery over the past few days. But again, as a long-term investor for the next decade, after doing some valuations and basing some fair net income figures and some very fair growth figures, I think there's a lot more upside here than downside. Everyone knows Google, of course, the owner of YouTube, the largest search engine in the world. That's search engines 1 and 2, with YouTube being the second one. And of course, the Android operating system, lots of other bets. Google Cloud, the brand itself, the moat is unbelievable. And I don't think the company is going to be going anywhere anytime fast. Now, a quick one on dividends as well. So I got 3 different dividends back in June. We've got some from Unilever, a big chunk from Legal & General, and also some from BP. So of course, even though I'd sold BP, I had owned the stock past the ex-dividend date. So remember, if you own a stock past the ex-dividend date, you will still be due the dividend from that quarter or that half of the year or whatever it might be, even though you might have sold the stock after it. So that one came through, which is quite nice, just to remind me that I'd held BP. And Unilever paid a very small amount. Legal & General, as you'll see on screen, paid the largest amount, which is quite nice. Now, rather than reinvesting that directly on the Hargreaves Lansdown platform, I actually just collected all that together. And I think, I'm not 100% certain, I withdrew that to my bank account. And then I did deposit that into my Lightyear account, which I do need to do a portfolio update on. And that's got some of these similar tech stocks in. But of course, the good thing about that platform is there's no commission and I'm able to change my pounds for dollars, zero commission as well. So I'm able to make those fractional shares and get those purchases I wanted to, rather than my Hargreaves Lansdown account. I didn't really want to pay £11.95 to make a trade on £400. All right, let's just take a little bit of time to go through some of the holdings in the account. As you can see, everything's broken down by the actual total gain or loss. Sitting right there at the bottom is the familiar face of Evraz. We've spoken about this one before, the Russian steel giant, and also involved in the coal industry as well. Unfortunately, this stock is not trading at all. And I think, as we mentioned last time, this is pretty much a big L. I think there's almost no way back for this company unless Russia all of a sudden decides that they want to pull out of Ukraine, make friends with the West again, and suddenly it gets listed back on the FTSE. I can't see this happening. So it's unfortunately one of those lessons that you're gonna have to learn. It's going to sit in the account until I can actually do anything with it. Who knows what's going to happen? At least during the time I had owned it for a couple of years, there were some good dividend payments there. Now, moving up to the second biggest loser in the account, a fund that probably a lot of you hold and was one of the biggest popular funds back in 2020 and 2021 is Baillie Gifford American. This one, in fact, is very similar to ARK in a way, Cathie Wood's fund. It's got lots of hype stocks in terms of the valuations just going completely crazy with the likes of Tesla, Shopify, just Trade Desk and others that I can't remember off the top of my head. Unfortunately, all of those, as you'll know, have come down massively. And at one point, Baillie Gifford American, I think, was down over 50%, which is an insane drop. And it's got a big chunk of my holdings in it, unfortunately. It's one of those things. I think it's a reminder that active fund management, although you can outperform for 1 or 2 years, doing that consistently is extremely difficult. No plans to sell it or anything like that, but it is just a reminder that active funds, ironically, in my account are all the way at the bottom. So I should probably just pick my own stuff. Just quickly moving up to that one, another fund that has done a little bit better and is actually recovering over the past 6 months is this iShares Global Clean Energy ETF. Again, I know a lot of you out there have actually got hold of this one. Again, unfortunately, though, this one was another one which saw a huge inflow of money from 2020. Everyone got very much excited. Clean energy and electricity with Tesla. They thought they'd make loads of money. And of course, just jumping on that bandwagon. Long term, I think the prospects are great for that. There's no doubt that clean energy is the way forward in terms of where investment's going. Which companies are going to succeed? Got no idea. Will the companies inside this ETF be the ones that succeed as well? Who knows? I think I'm confident on the sector, have a long-term time horizons. I'm really relatively happy with the purchase price. I did FOMO into it a little bit, if I'm honest with myself, but either way, I'm not going to touch that stock. Rather than skipping this horrible performing stock, which is actually the worst in percentage terms, let me pretend I'm on Who Wants to Be a Millionaire and you're the audience. So Deliveroo was a complete punt. I managed to get £1,000 worth of share pre-IPO for the company. Came into my account, it was literally down on IPO day, so I paid the full price and it's down where it is at the moment. So at the moment, I mean, the value is only, what, 250 quid. It would have to 4x to get my money back. Do I just keep it in this account as a big L to remind myself never to play in the pre-IPO market, or do I just sell it and buy something else? I'm tempted to just say just sell it. The annoying thing here is on Hargreaves Lansdown, it's going to be another £11.95 to make that trade, so that's even more out of it, but probably just sell it. I don't see a reason to keep that inside my account, but to be honest, I'll put that one out to committee. So let me know in the comments section, pause the video now and tell me what I do with this terrible kangaroo stock. As much as the service might be good, it's not going to be making many money for a long, long time. And then just moving up through the rest of the holdings, Unilever, of course, is still in a relatively poor position. I think it's had a little bit of a pullback since Nelson Peltz joined the board and took his stake in the company. I think ultimately, until this company splits up parts of its businesses, we're probably not going to see much shareholder return. It is a nice dividend payer and a big constituent of the FTSE 100. It's not going to go anywhere anytime fast. And in theory, it should be a good inflation hedge because their pricing power should enable them to push forward through any kind of downturn or any kind of recession, which let's be honest, we're probably heading toward, but anyone knows, it's anyone's guess what we're actually going into at the moment. We'll skip through PayPal because we've just spoken about them. AMD, what an incredible ride this stock's had. As you can see in my account at the moment, it's pretty much where I bought it, which is incredible because I think at one point it was either my second or third largest holding in terms of percentage gain. Pretty sure I saw it over 70 or 80% gain. So it's now kind of come back down to earth. Still think, and I think a lot of people can see this company has a lot of growth in front of it. And it all depends with a lot of these things. And I guess the more I get into investing and the more I understand it and I think about valuations, it's really all about the assumptions you make and how far out those assumptions you try and push. Of course, if you say AMD or any company like that can maintain 20 or 30% growth in revenue per year and also maintain healthy net margins, of course, that's great, but can the company actually do that? And it's actually only recently become profitable, and it had quite a few years where it was actually struggling a little bit, but it has seen a massive turnaround. And then just moving up to the biggest winners, of course, Apple is holding in there very well. A phenomenal stock, a phenomenal company, as we all know, big cash generating giant. Whether this company can actually go on and keep generating so much cash and keep generating so much return is, of course, going to be the big question. Now, there's a couple of ways Apple can do that, of course. They don't necessarily have to grow at like 20% per year. They've only really got to grow about 10% or kind of just at that inflation level. And then if they can return capital back to shareholders by buying back shares, and they do pay out a dividend, remember, even like 1% dividend. I mean, Warren Buffett gets a huge amount of cash from that back to Berkshire Hathaway. And if they can keep growing that and keep buying back shares, then you will get a good return and a good healthy return from this company. Will it beat the market from now on is always the big question. But it's a solid holding in the account and actually has maintained itself pretty well, still up 31%. Now let's talk about Nvidia. So similar in that AMD segment, huge graphics card and graphics chip maker, makes a lot of data center stuff and gaming stuff, which I'm very familiar with over the years. I've spent a fortune on Nvidia cards, not only for mining rigs, which I did do many years ago, but also for my own computer systems as well. So I understand the sector. Makes a lot of money, a phenomenal company, has seen a huge growth and a huge run up, unfortunately, which has now brought itself down back to kind of a more realistic level. And again, like we discussed with AMD, Nvidia is one of those shares, is one of those companies that it's all about what can it do now in the future. Can it maintain 20, 30, 40% growth year on year? Because it's already a very large company. Can it make it to that $1 trillion mark? And if not, can it make it even further than that? Again, I'm extremely bullish on that sector. There's not really anything stopping it in the way. There are going to be problems with the supply chain, of course, and it does need big customers and big companies to be doing very well to spend lots of money, but it'll be very interesting to have a look at this company in a few years' time. Jumping on to one of my favorite UK stocks here, and a big favorite, I think, of you guys as well as Legal & General. Big cash machine, very healthy dividends, very nice to get that paid. Of course, it's not reflecting the dividend paid in this gain or loss here, but it's still up 20% for the time that I've held it, which is pretty damn nice. Now, as I've said before, I'm not some crazy Tesla bull, and I'm not kind of the person who would ever say to put all of your assets into one kind of stock. Doesn't matter how bullish you think you are and how well you know the company, that sort of tactic is just extremely, extremely risky. That kind of concentration into one company, into one industry is extremely dangerous. And the big issue you now have with Tesla, who of course just reported their most recent quarterly deliveries, was although the company is clearly going to go through some supply chain issues, all about how fast the company can grow, obviously, but it's more now about the valuation. And of course, can we get ourselves back up to that kind of $1,200 mark? Can the company start making some real headwinds into these other sectors that of course they're promising, whether that's robotics, the full self-driving, or even energy storage? These are all areas that they haven't necessarily made big money from and big profits from, because just selling cars, unfortunately, although they do it very well and they're very profitable in that, is an extremely capital intensive business. And I'll be very, very interested how this one goes. So I'm happy with my position in Tesla. I'm not going to go crazy bullish and just increase all my position in it. I'm very grateful for the gains, but ultimately, this is kind of priced to perfection right now, in my opinion, and we'll see how it goes. And just before you head off, don't forget to watch my latest video, which is all about Berkshire Hathaway's letters from Mr. Warren Buffett himself. I've done all the reading for you and picked my top 10 best investment tips. And then finally, if you want to have a look at any of my playlists, don't forget to check out in the description. And I'll also put a kind of card on screen too. So that's all of my different portfolios. You're welcome to have a little pick through and have a laugh with me. Anyway, thanks so much for joining all the way to the end. Don't forget to drop me a like on the way out, subscribe for many more. And as always, happy investing.